Ralph Baker spent more than a decade working in finance before he turned his attention to encouraging young kids in Brooklyn, New York to take an interest in the stock market. The program was so successful, those kids were able to use their financial acumen to predict the financial collapse that occurred between 2007 and 2009. Well, joining us now to tell us how he and his kids did it is Ralph Baker. He's the author of Shock Exchange, How Inner City Kids from Brooklyn Predicted the Great Recession and the Pain Ahead. Welcome to the agenda.
Thank you.
Are we through the pain?
I don't think so. I think there's going, at least for the U.S., I think there's going to be a double-dip recession.
Okay. Well, let's go backwards. What exactly is the New York Shock Exchange?
It's a travel basketball team, and we teach kids how to pick stocks. So we use basketball as a form to teach financial literacy.
And what's your background in finance? You worked for 15 years in corporate finance?
Yeah, I worked at various companies. I worked at a company called GE Capital and Prudential Financial, doing M&A on the buy side.
Okay, so that's your professional background. What's your background in basketball?
I played basketball in high school and college. I was a small college All-American at Hampden-Sydney College in the late 80s. All
right, so you bring these kids, how old are they?
They were in the 5th, 6th grade when I first started.
So 10 and 11?
Yes.
Okay. You get these, are they good at, these kids good at basketball? Is that what they got going for them?
They were okay. They were okay. I took the better kids from a local recreational league, and we sold them on the idea of basketball. We're going to start a travel basketball team. And I purposely started with kids who weren't currently playing travel basketball. And I told them we were also going to learn how to pick stocks. They just really wanted to play basketball. And so I used the basketball as a carrot and the financial literacy portion as a stick.
And how's this work? So you're playing other teams, you're on the road with these, how many kids are they on this team?
Anywhere from 8 to 10.
Okay, so you're traveling with these 8 to 10. What's your interactions like with other teams? Because other teams are just there to play basketball. You got a dual purpose with your team.
Right. They wondered who we were. Like, what is the New York Shock Exchange? And we were okay on the court. But when the first season we had our investment meetings sort of ad hoc, like after practice and after games, sometimes in the park, and they would be looking at us kind of crazy, like who are these guys, talking about Apple and GameStop and going over analyst reports after a basketball game.
So literally, you're doing drills, you're practicing with your kids like a regular basketball coach, and after you're like, hey kids, come sit on the bench. We're gonna have a little chat about how we just practiced, how things went on the court, and now I'm gonna teach you about financial literacy.
Right, exactly.
I bet you got a lot of strange looks.
Yeah, the parents were curious as to how it would work, and I told the parents that financial literacy is a life skill. I told them about Peter Lynch, who was probably the greatest investor of my generation, and his philosophy was that you should invest in what you know. And he beat the market every year for like 10 consecutive years. He was the first person to do it. I told the kids that if Peter Lynch can do it, so can you.
But these are 10 and 11-year-olds. I mean, they don't even know what financial literacy means. What are they saying when you say, hey, you got to learn about the stock market? I'm going to tell you about this guy named Peter Lynch.
Well, I kind of brought it down to that level. I said, we started with a blank sheet of paper, and we said, hey, tell us about companies you think would make good investments, and tell us about products you use on a regular basis. And they threw out names like Apple and GameStop and Nike and Pepsi. I said, we're going to use investment fundamentals to help you narrow the list down to like 2 or 3 stocks. And then I'm going to pick a stock, and we're going to see who picks do the best. So for kids, if you make it competitive and they also have an audience, they become very engaged.
Where'd this idea come from, and what are you modeling it after?
Well, the backstory is that my dad taught me how to read the Wall Street Journal when I was in the 5th grade. He was a former Vietnam veteran, and he just threw the Wall Street Journal at me and said, read it.
Every day?
3-4 days a week. And when he got home, he would drill me on it. And that was the military way. I was a laughingstock in the neighborhood. We'd be out playing basketball in the afternoon, and I would go and have to read it's around 6 o'clock, and I have to watch the stock report and learn something about something called the Dow Jones Industrial Average or the Dow Transportation Index, so I could have something cogent to tell my dad when he got home. And so my son was in the 5th grade. I said, hey, maybe it's time for him to learn about financial literacy or about the stock market, but try to make it more of a soft sell.
So your dad, as you said, it was the military way, made you do it.
Right.
And you're like, hey, I learned from this. I benefited from a young age learning about financial literacy and becoming literate, helped you out clearly in your professional life. You said, I need to pass this on to my kid just in a different way.
Exactly.
What was your son's response when you said he had to learn this?
Well, he wanted to play basketball. And he said the New York Shock Exchange was the dumbest name he'd ever heard. And if I didn't change it, he was going to quit. And he was just going to go along with it because I was his dad. But they were kind of resistant to it. And what ended up happening was that their stock picks trounced mine. We tracked these stocks, and a year later, Apple had, we narrowed the list down to Apple and GameStop, and Apple had 113% return. GameStop had an 82% return, and my stock had a negative 1% return. So when they figured out that they were better investors than me and professional investors, they became emboldened by it, and they really liked it.
I want to talk about them investing in just a minute, but there is, I'm thinking of you, a coach of a basketball team of young kids. Most of you, if you're doing picks, you're doing it for, March Madness, you're doing a draft like that. What is it about basketball? Is there a marriage between basketball and picking stocks? Is there something in basketball that lends itself well to picking stocks?
I don't think necessarily. Basketball was something that I knew. If I knew something about architecture, I would use architecture as a way to teach them about picking stocks. But we did bring it down to their level in terms of like these investment fundamentals, like price to earnings ratio and earnings growth rate. We showed them charts of like Dwayne Wade and Kobe Bryant and Michael Redd and Ray Allen. We showed them how much they made per rebound or per point. And we had them say, hey, if these guys were stock, who would you pick? And they all picked, back then in 2006, they picked Dwayne Wade. I think Kobe made about 6,800 per point scored. Ray Allen made about 6,600. Wow. Michael Redd made about 6,100. And at that time, Dwayne Wade made about 1,800 per point scored. But he was on the rookie contract, so the cap on how much he could make. And they said that they thought Dwayne Wade had the biggest upside, so they picked him. And then in hindsight, they were correct, because today, when he's healthy, Dwayne Wade is probably the best shooting guard in the league. But we brought it down to that level, and we explained these sort of investment fundamentals in basketball terms. But I think particularly for professional athletes, I think financial literacy is very important, because when scam artists look to make a quick dollar, they tend to approach people who come into large sums of money at a very young age. And those tend to be professional athletes. Okay,
so you're working with these kids, teaching them this, using not fictitious, but not real money, investing at this point. But then you said that you talked to them about Apple and GameStop. Do they literally invest real money on the stock market?
Yeah, we invested a couple $100 into each stock. More just not to make money, but just to make it easier to track the stocks, track their performance. And back in 2006, I tried to talk them out of investing in Apple and GameStop. I thought Apple was dead in the water. They were, high on this iPod product that Apple had. They said it was
never heard of it.
Yeah, so it was not only a media player, but it was also a status symbol. Everybody wanted one. One kid said his mother even took it into the shower with her, which I thought was a little too much information. But they said it was very user-friendly compared to competing products. And they said GameStop was the distributor of choice for games, and they loved playing video games. They said it had a very educated sales force compared to competition. They also said it would be a hedge against inflation, a hedge against this recession I kept talking about, because you could trade in used games for credit towards new games. So if the economy turned down, people still buy games, they just buy more used games.
So this is 2006.
2006.
It's not legal for kids to actually invest in the stock market, is it? You're putting the money in.
Right.
Okay.
Right.
All right. I just wanted to make sure that. Okay. So we're going to jump ahead to exactly how they predicted the Great Recession, as it's called. But in this day and age, we're now in 2014, what do you think we all need to know, everyone should know about the stock market in order to be at least at the basics financially literate?
I think basic things that you should know are, if you think the equity market is overvalued, which I do, it may not be a good time to put your money in equity products. If you think interest rates are going to rise, which I think they will, because rates are extremely low right now, record low levels, and rates can't fall from the floor. And so when rates rise, what happens? Probably not a good time to put your money into long-term bond funds, because when rates rise, you may lose some of your principals. These are sort of basic things that all investors should know.
It's like you're speaking a foreign language to me. I understand none of that, which I only say because I think I'm like a lot of people who we have investments, but we don't really know what we're doing with our investments.
Right. It's paramount in the U.S. because there are no more pension funds. They're going to take care of you in retirement. And for most of the kids in my program, their biggest asset other than their home is going to be their 401k plan. And how
What's that?
It's like a retirement plan.
Okay.
And how well you live in retirement, what you're responsible for. You put your own money in it, you make your own investment choices. And how well you live in retirement and how the money you have saved for retirement is going to be predicated on how you pick stocks within your 401k plan or how you choose funds within your 401k plan.
So a lot of adults are really bad at picking stocks. Is there something about kids that make them especially adept at being good at picking stocks?
I think so. I think what I learned was that kids spot trends before adults do. They're always trying something new, and And in a lot of ways, they are trendsetters. So while you and I are maybe using Twitter or Facebook, they're on to the next new thing, whether it's whether it's Snapchat or Instagram. So they're very good at finding the next growth company or the next growth industry. So they should make better investors in some ways than adults.
So you're sitting in 2006. What trends are these kids seeing that are sort of, pointing towards a Great Recession that many, many, many economists just weren't seeing at the time?
Well, we just at a cursory level, we went over these sort of these investment fundamentals at a grassroots level as far as price to earnings ratio and earnings growth rate. We also looked at the market from a top-down perspective. I told the kids there are forces that would affect the stock market and affect Apple and GameStop that weren't germane to Apple and GameStop. For instance, if the economy turned down, the stock market would turn down, and also Apple and GameStop would also turn down. And I told them about these two big ticket items, housing starts and auto sales. You track those two big ticket items, you can pretty much track GDP. So, and part of our investment meetings, we would go over these trends, and just at the cursory level, just to show them, what an investment process looks like. And over time, we started noticing that these trends became very negative, and ultimately started falling off a cliff, and nobody was talking about it.
So they're saying, hey, Coach, I'm noticing something here. Doesn't look like these two indicators that you said were really, really crucial. Things aren't going so well. We're in trouble. They're saying this in 2006, 2007?
Right. We had first started blogging. We have a website. We only blogged about the team and the investment performance. And over time, we started blogging about the economy because nobody else was talking about it. And that's what we were seeing during whenever we had an investment meeting. And in 2008, when ultimately when Fannie and Freddie failed and Lehman Brothers failed, the rest of the country woke up and said, hey, we have a problem.
Okay, there's been, we can lay this at the foot of economists who didn't predict this, but there are also a lot of people who said, you know what, politicians and the media fed into the crisis that came to pass. How culpable were the politicians and the media in the crisis, do you think?
I think at a 20,000 foot level, economics, the recession was a good thing and a bad thing. The bad thing is a lot of pain for a lot of people. The good thing is that it's brought economics back into the forefront. People thought economics was a dying sort of science, and then only people studied with a bunch of dinosaurs. Now, anybody who can understand the economy and explain the economy is in demand. But I think the media and politicians at the time, I think politicians set laws that were favorable to, want and speculation on Wall Street. Countries go through periods of economic expansion, economic recession all the time. It's just that the Great Recession was a recession on steroids because of all the wanton speculation from big business and Wall Street and real estate and mortgage-backed securities.
Things are better now. How do you think the Obama administration dealt with the crisis? Think they did well or not?
I think they sort of just threw money at the problem. They gave certain Wall Street firms like about $8 trillion in zero interest loans. They also lowered interest rates as a boon for the economy. So I think he had a very poor hand. I think he played it poorly. I think economists have something they call marginal propensity to consume, and what that is that for every dollar in tax savings you give a middle income or low income individual, they may spend 80% of it. Wealthy individuals may spend 20% of it. So we say that middle income individuals and low income individuals have a higher marginal propensity to consume. So if you want to jumpstart the economy, you would give benefits to them. And so when they lowered interest rates have benefited. Only people who've benefited from low interest rates have been big business, private equity firms, and Wall Street who've been hoarding the cash. So we spent about $3-4 trillion on something called quantitative easing. Yet the people who are going to spend the money can't necessarily get access to the lower rates.
So interest rates, the housing bubble that was in the United States. So 2006, we have people like, not people like, because he was actually stood alone in a lot of ways, economist Nouriel Roubini, who goes to the International Money Fund and he says, listen, the U.S. economy is in trouble. We're going to have a housing bust, a deep recession. And he sort of takes them through the steps, I think it was like 12 steps or something, of what was going to happen to lead to this recession. You were doing it on the court with your kids. You guys were seeing the same trends, but you guys weren't called, as Roubini was, a naysayer, a pessimist, Dr. Doom. Are we weary of people and just don't want to hear from people who have gloomy economic predictions?
Somewhat. I think in the U.S., sort of what's good for big business, what's good for Wall Street, people think it's good for the country. Again, I think there are very few people who can even understand the economy, and they're coming back into the forefront. But I think also at that level, in that rarefied air, when you're talking about politicians, presidents, senators, and congressmen, they really don't want to scare the public. They may have information that's maybe different from what they're saying publicly. They don't want a panic from the public. So they may sort of try to spoon feed the public or try to sugarcoat things in some ways.
Is that a fair way to go about business, though?
I don't think so. I mean, that's why you have books like this. I think I wrote the book to inform the public, to explain to someone like my mother who doesn't have a background in economics exactly how the economy works. So when you go through all these stories about my background growing up in basketball and the stories of the kids, when you get to the end of the book, you will have learned how the economy works, and you've been given the tools to how the economy works and to somewhat how the stock market works, and you can make your own informed decisions.
I want to ask you about, because we're 8 years since this program first started, New York Stock Exchange, since the team started. Where are they? What's your son doing now?
He's a freshman in college. He goes to Lehigh University. He's the kid on the cover of the book. Most of the kids are either in college, just graduated from high school or in college, or working. So I have to go out and start a new team, which I'll probably do next summer.
And are these kids, are they studying economics?
Well, some of them are. My son has always talked about being a mechanical engineer. So he's studying engineering. He also told me a couple months ago he's going to minor in business, which kind of warmed my heart. I think it's a direct result of being a part of the program. And I had one kid who wants to do an internship with the New York Stock Exchange. So I was kind of surprised by that. I think ultimately when these kids have to invest in stocks themselves and their working lives, I think they're going to embrace the challenge. I think they won't be as intimidated as maybe other adults who haven't had exposure to investing as kids.
So you said you're going to start a New York Stock Exchange team again?
Yes.
Okay, this year?
Probably next summer.
Okay, what are you going to teach them in the summer of 2015 that you weren't teaching kids in 2006?
I think we're just going to start over. We're just going to give them a blank sheet of paper and say, you guys have at it, and just see what they say and what they think, and just sort of update what we've already done. But just sort of pick their brains as far as what products they're using now and what they think would make great investments, and just see where it goes.
Okay, so in 2015 or 2014, just kind of paint the picture for us. I mean, what conditions exist today that you see, Ralph Baker, that could lead to another crisis, or are we just out of the water? Are we good?
I don't think we're out of the water. For the book, I did this economy is sort of like the economy that was around when I first came out of college in 1989. So I did a 10-year chart from like around 1986 to 1995, which showed that recession, and I showed a chart of like housing starts and auto sales and how it affected GDP and ultimately unemployment. I also showed a chart from 2001 to 2011, just compared the two. And what I found was that when housing starts and auto sales turn down, GDP turns down that same year, then unemployment spikes the next year. And also what I found was that housing starts got as low as 654,000 in 2009, and they had never fallen below 1 million, even going back to the 50s when people first started tracking it. And I found it very alarming. And they've never reached pre-crisis levels. And this is the best case scenario with this very low interest rate environment. So what's going to happen when rates rise? When rates rise, I think it's going to choke off housing starts and auto sales again and lead to a lower GDP and ultimately high unemployment.
We're going to call you Dr. Doom from now on.
Well, just as what I'm seeing. I just look at the facts and follow the fact pattern.
Okay. So a question that has been lingering for the last number of years is that with the Fannie Mae's, the Freddie Macs, and so on, I could go on and on. There's these high-level execs that made mistakes. Why weren't they prosecuted in connection to the Great Recession?
I beg your pardon?
Why weren't they prosecuted? Why is it financial crime so difficult to prosecute?
I don't think it's difficult to prosecute at all. Just hasn't been prosecuted. Right. I think you have to look at there was a line of demarcation in the Oval Office. I think you have to look at the revolving door between Washington and Wall Street. You look at H.W. Bush when he left office. He worked for a private equity firm. His vice president, Dan Quayle, works for Cerberus, which is a private equity firm. Bill Clinton, when he left office, he worked for a private equity firm. Al Gore worked for a private equity firm. Bill Clinton's daughter Chelsea Clinton worked for a private equity firm. So something about the Oval Office that when these guys go to the White House, they come from different backgrounds, politics, or in H.W. Bush's case, from the CIA. They leave as talking red wells of financial acumen. And basically, these guys are going to Wall Street, and they are making so much money that they, their children, nor their children's children ever have to work again. And I think it's sort of a quid pro quo where we'll make you rich, and you don't rein in wanton speculation, and you don't prosecute us.
So there's no political will, there's self-interest, and just this deal-making that you just turn away from it, don't prosecute it.
I think you start there, but there's been legal precedence for a lot of the wanton speculation and outright fraud that's taking place during the financial crisis. I think it's an outrage. The U.S. is the most incarcerated country in the world, yet there's examples of outright fraud and wanton speculation, and nothing's been done about it.
We have seen a couple of traders be prosecuted in the U.S., some being sent to jail. I mean, is it plausible that you can have a rogue trader, one bad trader executive, get away with fraud without their bosses or higher-ups even knowing about what's going on in the company?
I don't think so. I mean, if there could be limited scenarios, but if a guy is his division is making 10, 20% of the company's earnings, I think everybody knows how he's doing it.
You called it an outrage, and I think that probably many Americans are upset that people didn't go to jail over what happened with the financial crisis. Do you think things have changed? I mean, is there a sort of a precedent now that exists for going after Wall Street execs?
I think so. I think there's a judge, Jed Rakoff, who rejected a recent SEC Citigroup settlement where Citigroup was accused of investing in the CDOs, and they what they call fobbed them off onto unsuspecting clients. And the clients lost about $600 million. The SEC settled with them, gave them a slap on the wrist, and they signed boilerplate language that they neither denied nor admitted any wrongdoing. And Judge Rakoff rejected it and sent it back. And he said that the SEC has a responsibility to see that the truth emerges. And he also said that it seems like the SEC is more intent on making these sort of getting these high-level public relations sort of settlements. And since then, it's sort of through sort of a shot across the bow, so to speak. And I think a lot of judges are going back and revisiting cases, and I think the Citigroup case is going to be looked at very closely as far as what happens going forward. Can you actually prosecute these white-collar criminals? And he's also written an op-ed piece to the New York Review of Books saying that, companies don't commit fraud, individuals do. And prosecuting individuals is the best deterrent to these white-collar crimes.
Well, the big slogan out of the financial crisis was, too big to fail. Are there CEOs and execs that are just, I don't know, too big to put in jail?
I don't think they're too big to put in jail. I think there's two different issues. Some of these companies are too big to fail. If a J.P. Morgan or Morgan Stanley were to collapse, they couldn't pay their counterparties, and their counterparties couldn't pay their counterparties. So it would be a systemic risk to the financial system. But I don't think these guys are too big to jail. I just think that the SEC has been going for these sort of these high-profile headlines and haven't done the real work and based on legal precedents to prosecute these guys.
We talked about your kids and what they're doing now, the Shock Exchange team. How'd they end up doing on the court anyway in basketball? Did they come out on top?
I think we've had our own level of success. It may not be successful in terms of like how people think of wins and losses. We started out okay, and as the kids got better and better over time, other teams started stealing our players. So I would tell people that if you have a team and nobody wants to steal your players, that's not a good sign. Or if you're dating somebody, you're married, and nobody wants to steal your wife, that's probably not a good sign. So I think we've been successful that kids who come through our program have become better players. I think they become better, at financial literacy, and some have gone on to other programs for success. But I think overall we've been very successful, and the kids are known more for what they do off the court. We also have a tournament called Shock Exchange Come to Harlem, which is one of the top tournaments in New York City. So we've made our name in our own sort of space. So we're sort of in our own lane.
Ralph Baker, fascinating program. Thank you for telling us about it and helping us out with dealing with the financial whatever that's on the horizon. Thank you very much.
Thank you.
Support Ontario's public television. Donate at tvo.org.